That assumption failed completely on a rainy Tuesday morning when an independent contractor named Arthur Vance received a notification that his monthly account maintenance fee had bounced. The amount was trivial, exactly $12. Arthur had plenty of funds sitting in his secondary savings account, but due to a processing delay on a client's direct deposit, his primary checking balance had briefly dipped below the required minimum. Under normal circumstances, Arthur would have just moved the money over, accepted the tiny hit, and moved on with his week. However, when he attempted to log into his online portal to clear the balance manually, he discovered something highly unusual. The bank hadn't just flagged the account, they had completely locked his access, claiming the $12 deficit constituted a high-risk security breach. When Arthur called the customer helpline, he wasn't looking for a fight. He simply wanted to authorize a direct transfer from his savings to his checking to wipe out the $12 debt. The representative on the line, reading from a rigid script, informed him that because the account was in a restricted status, no electronic transfers could be initiated by the client. The only way to resolve the restriction was to physically visit a branch and present a certified payment. This was the first major point of contrast in how the bank handled the situation versus how an actual human would reason. To a human, a $12 internal transfer is an instantaneous, zero-risk correction. To the bank's automated compliance protocol, Arthur was treated with the same level of suspicion as an international money launderer. Determined to put the matter behind him, Arthur drove to the nearest branch the following morning. He walked up to the teller window, laid down a $10 bill and 2 ones, and asked to have the cash applied directly to his checking balance to lift the restriction. The teller typed into her terminal, frowned, and called over the assistant branch manager. What followed was a masterclass in bureaucratic stubbornness. The manager explained that because the account had been restricted by the central compliance algorithm, the local branch could not accept cash payments for outstanding fee balances. The system required an external electronic ACH pull from an outside institution, or a cashier's check drawn from a different bank. Arthur looked at the manager, genuinely bewildered. He was standing inside the bank that held his money, offering the exact legal tender printed by the federal government, to pay a debt issued by that very same bank, and he was being told that his money was not acceptable currency to clear his account. The manager's response was a shrug and a familiar phrase, "I'm sorry, sir, but the system simply won't let us override this." It was the ultimate shield of the modern corporate worker, the total abdication of personal agency to a software program. What the branch manager did not realize was that Arthur was not an average consumer who would walk away frustrated. He was a meticulous archivist of his own financial life, and more importantly, he understood the legal obligations of a licensed financial institution. When the bank officially refused to accept his cash payment, Arthur did not raise his voice. He didn't demand to see a higher executive. Instead, he calmly asked the manager to provide the rejection in writing. He wanted a formal document stating that the bank was refusing to accept U.S. currency for a debt owed to them. The manager, eager to get this stubborn customer out of his lobby, hastily typed up a standard branch memo, signed it, stamped it with the bank's official seal, and handed it over. That single piece of paper changed everything. By refusing a valid legal tender offer to settle an internal administrative debt, and documenting that refusal under an official corporate seal. When Arthur sat down at his desk that evening, he didn't log back into his frozen account. Instead, he pulled up the public database for the Office of the Comptroller of the Currency, alongside the Electronic Fund Transfer Act guidelines. He wasn't looking for a loophole to save his $12, he was looking for the exact mechanism the bank used to justify locking his funds. What he discovered was a gaping flaw in the bank's automated compliance architecture. The software had been programmed to treat any uncollected maintenance fee on an account that had brief periods of inactivity as a potential zombie account fraud risk. To save money on human auditors, the bank had completely outsourced its risk assessment to an aggressive, poorly calibrated algorithm. If the algorithm flagged an account, it locked all linked assets, including Arthur's entirely separate savings balance, effectively holding his legitimate money hostage over a fee the bank itself had invented. This is where the contrast between standard customer service complaints and a targeted regulatory strike becomes clear. Most consumers file a complaint with the bank's internal resolution team. which is essentially a black hole designed to stall until the customer gives up. Arthur bypassed the bank entirely. He drafted a formal, multi-page administrative notice directed to the Consumer Financial Protection Bureau and the state's banking division. Attached to this notice was a high-resolution scan of the branch manager's signed, stamped memo refusing to accept cash payment. He framed the issue not as a minor technical glitch, but as a systemic practice of illegal asset retention and refusal of legal tender. Arthur's argument was mathematically tight and legally devastating. By locking access to his entire savings account over a disputed $12 checking fee, and subsequently refusing to accept cash to resolve the balance. The bank was engaging in an unauthorized freeze of consumer assets without due process or valid regulatory cause. He didn't just submit the paperwork online, he sent physical, certified copies directly to the bank's chief compliance officer at their corporate headquarters, requiring a signature upon delivery. For the first few days, there was absolute silence. The automated systems continued to send Arthur generic, computer-generated alerts warning him that his account remained in restriction and threatening additional legal penalties if the balance wasn't cleared. It was a stark reminder of how disconnected the corporate head is from the digital limbs of a modern financial institution. While the automated system was blindly accelerating toward a default judgment, Arthur's certified letters were quietly moving up the escalator of the corporate legal department. The turning point occurred precisely 11 days after the certified mail was signed for at headquarters. It didn't start with a phone call to Arthur, it started with an unannounced visit to the local branch where Arthur had been turned away. A regional compliance auditor, accompanied by an outside legal representative, arrived at the branch shortly after opening. They weren't there to audit the vault or count the cash drawers, they were there to seize the internal security footage and digital logs from the day Arthur walked in with his $12. The branch manager, who had so confidently hidden behind the phrase, "The system won't let me," suddenly found himself sitting in a closed-door meeting explaining why he had put the bank's official seal on a document that openly admitted to violating federal retail banking guidelines. What the branch staff failed to realize was that Arthur's complaint had landed on the desk of a federal analyst who was already investigating that specific institution for systemic software anomalies. For months, the regulatory agencies had been receiving vague, scattered complaints from consumers claiming their accounts were being frozen without explanation. However, most of those complaints lacked definitive proof, they were just frustrated stories from people who couldn't get a straight answer from a customer service representative. Arthur's document changed the entire scope of the investigation. It was the smoking gun the regulators needed, an official, written confirmation that the bank's operating policy was actively rejecting consumer attempts to rectify minor balances, thereby artificially keeping accounts restricted while inflating their internal metrics for risk mitigation. By the start of the third week, the ripples from Arthur's $12 dispute had breached the inner sanctum of the bank's executive suite. The institution's chief risk officer received a formal administrative subpoena from the Federal Review Board, demanding the immediate production of the source code governing their automated fraud detection and account locking protocols. The bank was no longer dealing with a minor customer service issue, they were facing a top-tier structural audit that threatened their very license to operate as a national depository institution. The algorithm that was supposed to save them millions in human labor costs had just opened the door to a federal review that could cost them tens of millions in regulatory fines. Cumulative word count, 1,800 words. This second section escalates the conflict, showing how Arthur's precise, legal approach transformed a personal inconvenience into an institutional vulnerability, leading up to the arrival of federal scrutiny. The transition from a quiet administrative inquiry to an active federal review happens with terrifying speed inside a major financial institution. At the bank's corporate headquarters, a sprawling glass tower designed to project an image of absolute stability, the atmosphere shifted overnight from corporate complacency to absolute panic. The executive elevator bay, usually silent and predictable, became a revolving door for outside defense counsel, compliance specialists, and panicked senior vice presidents. The administrative subpoena issued by the regulators wasn't a request for cooperation, it was a mandate. The Federal Review Board gave the bank exactly 72 hours to hand over every line of code, every internal memo, and every training manual relating to their automated risk management software. To understand why the executives were sweating over a $12 trigger, you have to look at how modern banks make their margins. In the banking world, software automation is sold as the ultimate tool for efficiency. By replacing human compliance officers with an algorithm, the bank can monitor millions of transactions simultaneously for a fraction of the cost. The problem is that algorithms don't possess common sense. They are binary systems operating on strict parameters. If the parameter says, lock account if balance stays negative for 48 hours during an inactivity window, the software will execute that command regardless of whether the deficit is $12 or $12 million. The bank's leadership had knowingly accepted this risk because the cost of paying a few compliance settlements was far lower than the cost of employing thousands of human beings to review accounts manually. But that calculation only works if the settlements stay private. Arthur's formal filing with the Consumer Financial Protection Bureau had effectively bypassed the bank's non-disclosure agreements and internal settlement pipelines. It became a matter of public regulatory record. Because the federal analysts now possessed an official branch memo confirming the practice, they didn't just look at Arthur's account, they used their federal data privileges to run a retrospective query across the bank's entire national database. What they found was a systemic pattern of economic disruption. Over the previous 18 months, the bank's automated system had erroneously locked over 40,000 accounts nationwide for minor, sub-$20 administrative fees. The scope of the disaster was staggering. Thousands of regular people had been frozen out of their money, unable to pay rent, buy groceries, or cover medical bills, all because an unvetted line of code had classified their minor fee deficits as high-risk security threats. Even worse, because the software automatically restricted communication once an account was flagged, the vast majority of those 40,000 customers had been completely unable to reach a human being who could fix the error. They were trapped in the exact same digital loop that Arthur had encountered, but unlike Arthur, they didn't have the legal background or the documentation to fight back. They had simply suffered in silence, paying the fees through outside channels or watching their credit scores deteriorate. When the Federal Review team physically arrived at the bank's headquarters on Monday morning, they didn't arrive with briefcases, they arrived with specialized IT forensic investigators and federal marshals. They took over an entire floor of the legal department, setting up a secure command center. The contrast between the bank's polished corporate image and the cold reality of a regulatory raid was stark. While frontline employees were helping customers at teller windows across the country, federal data analysts were pulling hard drives directly from the server racks in the basement of the corporate offices. Every email sent by the risk management team regarding the deployment of the software was flagged for review. By Tuesday afternoon, the internal communications logs yielded exactly what the regulators were looking for: intent. The forensic team uncovered an internal email exchange from 2 years prior between the chief technology officer and the head of retail banking. In the exchange, the technology team explicitly warned that the automated compliance software had a high rate of false positives and was routinely locking legitimate consumer accounts over minor fee disputes. The response from the retail banking executive was chillingly pragmatic. He noted that the cost of fixing the software glitch would exceed $3 million, whereas the revenue generated by customers paying outside fees to unlock their accounts was netting the bank over $8 million annually. The executive concluded the email with a single sentence: "Let the system run, the friction works in our favor." This was the definitive turning point of the entire federal review. The investigation was no longer about a technical glitch or a poorly trained branch manager, it was now a criminal fraud inquiry. The bank had knowingly used a flawed automated system to trap consumer assets, actively creating administrative friction to force vulnerable customers into paying unnecessary costs. The $12 payment that Arthur tried to make wasn't just rejected by a broken machine, it was rejected by design, as part of a deliberate corporate strategy to maximize fee collection through digital entrapment. As the week drew to a close, the Federal Review Board issued an interim order that sent shockwaves through the financial sector. They demanded an immediate, nationwide halt to the bank's automated account locking protocols. Furthermore, they ordered the bank to establish an independent escrow fund to prepare for mass restitution to the 40,000 affected consumers. The multi-billion-dollar institution that had spent years telling regular people that the system cannot be overridden was now being forced by the federal government to rewrite its entire operating structure from scratch. The public exposure of the internal emails transformed a closed-door regulatory audit into a full-blown national scandal. When the Federal Review Board leaked portions of the corporate log files to the press, the phrase, "Let the system run, the friction works in our favor," became the headline of every major financial news outlet across the country. The contrast between the bank's expensive marketing campaigns, which marketed the institution as a trusted community partner, and the internal reality of intentional consumer entrapment was too stark for the public to ignore. Within 48 hours of the leak, the bank's stock price plummeted by 14%, wiping out billions of dollars in shareholder value as institutional investors rushed to distance themselves from the unfolding legal disaster. For the senior executives who had signed off on the automated system, the glass tower at headquarters was no longer a symbol of corporate sanctuary, it had become an accountability trap. The chief executive officer, who had spent years presenting glowing quarterly earnings reports driven by digital efficiency metrics, was forced to call an emergency board meeting. The board of directors, looking at a catastrophic loss of institutional reputation and facing massive class action lawsuits, offered the executive suite no protection. By Thursday evening, both the chief technology officer and the head of retail banking had submitted their immediate, non-negotiable resignations. The very system they deployed to squeeze millions from vulnerable consumers had ultimately cost them their careers and erased their corporate legacies. Meanwhile, Arthur Vance remained completely detached from the corporate chaos he had set in motion. He didn't participate in the media circus, and he declined multiple offers to appear on cable news networks to discuss his role in bringing down the executives. For Arthur, the objective was never to destroy a bank, it was simply to enforce a basic principle of fairness and legal accountability. When an independent journalist finally tracked him down at his home office and asked how it felt to cause a multi-billion-dollar regulatory crisis over a $12 fee, Arthur's response was characteristically precise. He explained that the scale of the crisis was entirely the bank's own creation. If the branch manager had simply accepted the $12 in cash, or if the compliance department had employed a single human being to review the initial restriction, the machine would have corrected itself. The bank didn't fall because of a $12 error, it fell because it built an empire on the assumption that nobody would ever look at the foundation. The Federal Review Board's final enforcement action was delivered exactly 1 month after Arthur's initial certified letter arrived at headquarters. The document was a comprehensive, legally binding consent decree that fundamentally altered the parameters of retail banking compliance. The regulators imposed a historic civil penalty of $45 million for intentional consumer deception and systemic violations of the Electronic Fund Transfer Act. But the financial penalty was only the beginning of the institutional damage. The decree mandated that the bank must completely dismantle its automated risk management software and replace it with a transparent framework monitored by a permanent, court-appointed independent auditor. Furthermore, the bank was ordered to issue full restitution to every single one of the 40,000 consumers whose accounts had been wrongfully restricted. This meant the bank had to calculate not just the return fees, but also the compounding financial damages caused by the freezes, including accrued late fees from landlords, utility companies, and credit score rehabilitation costs. The total operational cost of the remediation process was estimated to exceed $120 million, making it one of the most expensive compliance failures in modern financial history. The line of code that was meant to save $3 million had ultimately cost the institution more than 50 times that amount in penalties and liquidations. The broader impact of the case rippled outward through the entire financial services industry. Regulatory agencies used the precedent set by the review to issue new, sweeping guidelines across all national depository institutions. The new rules explicitly prohibited banks from using fully automated algorithmic systems to restrict consumer access to checking or savings accounts without direct human verification and a mandatory 48-hour warning period. The era of the unvetted, fully autonomous compliance machine was effectively over. Financial institutions nationwide began quietly auditing their own software systems, scrambling to eliminate aggressive billing codes before the Federal Review teams arrived at their own doors. Arthur's stubborn insistence on a written cash rejection had created a regulatory shield that protected millions of bank accounts across the country. The true legacy of the $12 dispute became apparent during the subsequent congressional hearings on consumer banking protections. Members of the Senate Financial Services Committee used the bank's internal memos as a prime example of corporate overreach in the digital age. The hearings exposed a dark truth about the modern financial landscape. As institutions migrate to artificial intelligence and automated platforms, the human element is deliberately erased to shield corporations from liability. When a computer program makes an illegal decision, the company can claim it was an unintended software anomaly rather than an intentional policy choice. Arthur's case shattered that defense forever, proving that a corporation is entirely responsible for the actions of its automated algorithms. In the months following the federal review, the bank's headquarters underwent a profound physical and cultural transformation. The floor that once housed the risk management technology team was converted into a dedicated consumer advocacy and manual review division. Hundreds of newly hired compliance officers sat at desks that were previously occupied by servers, manually reviewing account alerts and ensuring that no customer balance was ever frozen without a comprehensive human audit. The bank's new leadership launched a massive rebranding campaign, but this time, the focus wasn't on digital efficiency or seamless automation, it was on absolute transparency and human accessibility. They learned the hard way that consumer trust cannot be automated, and that a single verified human signature is worth more than 1 million lines of unchecked code. For everyday consumers, the resolution of Arthur's case marked a major shift in power balance. The standard response of, "the system won't let us," lost its absolute authority. People began to realize that corporate software programs are not immutable laws of nature. They are merely business tools subject to the same consumer protection statutes as any physical storefront. Across the country, banking clients began demanding written documentation whenever their transactions were arbitrarily declined or their funds were restricted, using the exact same strategy Arthur used to pierce the corporate veil of non-responsibility. The story of the rejected $12 payment serves as a vital reminder of the value of individual vigilance in an increasingly algorithmic society. It demonstrates that the massive scale of modern financial institutions is actually their greatest structural vulnerability. Because they operate on a massive scale, an error in their code is never a localized event, it is a systemic infection that runs through their entire enterprise. When an individual has the patience, the clarity, and the documentation to expose that infection, the entire corporate structure can collapse under the weight of its own automated contradictions. Arthur Vance didn't have a legal team, a public relations firm, or millions of dollars in capital. He simply had a $10 bill, 2 ones, a signed piece of paper, and the unwavering conviction that the fine print applies to everyone equally. When the final restitution checks were sent out to the 40,000 affected customers, each envelope contained a formal letter of apology signed by the bank's newly appointed chief executive officer. The letter didn't blame a technical glitch or a software vendor, it openly admitted that the bank had failed to maintain the human oversight required to protect its patrons. The total cost of the entire ordeal reached $165 million in civil penalties, administrative restructuring, and consumer compensation. The $12 check that started it all was framed and hung on the wall of the Federal Regulatory Archive. A permanent monument to the time an ordinary citizen forced a multi-billion-dollar banking empire to submit to a federal review. The profound impact of this case eventually led to what consumer advocates now call the Vance Doctrine in corporate compliance. This principle dictates that any financial institution utilizing automated machine learning to govern consumer assets must maintain a live, human-operated override protocol that is accessible to the public 24 hours a day. The standard practice of hiding behind automated phone menus and unmonitored help desks was officially recognized by federal regulators as a form of predatory corporate obstruction. The systemic vulnerability exposed by Arthur didn't just change the operational reality for one predatory bank, it forced every major lender on Wall Street to fundamentally re-evaluate their reliance on autonomous risk management. Behind the closed doors of banking conventions and financial tech seminars, the tone shifted from celebrating cost-cutting algorithms to managing regulatory exposure. Industry analysts openly admitted that the era of uncontested digital fee harvesting was over. The financial cost of setting up manual compliance teams was high, but the cost of ignoring the human element, as evidenced by the historic $165 million liquidation, was completely unsustainable. Companies realized that when you eliminate human judgment from customer relations, you also eliminate the empathy that prevents a minor technical glitch from turning into a devastating public relations nightmare. For Arthur Vance, life returned to its quiet, predictable routine. He continued to manage his independent contracting business, keeping his meticulous financial logs just as he had always done. He eventually moved his capital entirely out of the traditional corporate banking network, transferring his funds to a local, member-owned credit union where the tellers knew his name and the managers possessed the actual authority to make decisions. The multi-billion-dollar tower at headquarters still stands as a monument to financial power, but inside its walls, the architecture of control has been permanently altered. The lesson of the $12 payment remains a stark warning for any massive institution that seeks to automate its ethical obligations to the public. It proves that no matter how advanced the software, how large the profit margins, or how complex the compliance architecture, a corporation can never completely escape its fundamental responsibility to the individual. The machine is only as strong as its weakest parameter, and corporate power is only absolute until an ordinary citizen decides to read the fine print, stand their ground, and demand that the rules be applied evenly. When the bank rejected his $12, they thought they were managing a minor line item. Instead, they unlocked the precise mechanism that exposed their entire network to the cold light of federal scrutiny, reminding the financial world that the human element can never be completely overridden.